Welcome to the deep dive. Today we're taking a really thorough look into the Q1 FY26 financial results of Ajanta Pharma Ltd.
Mm-hmm.
And this isn't just about the numbers, right? It's about understanding the deeper story behind how this significant player in the pharma industry is performing.
Yeah, exactly.
We've pulled together a whole stack of sources for you.
Mhm.
The formal board meeting announcement, the detailed press release, the unaudited financials, auditor reports, that in-depth investor presentation, and really importantly, the actual earnings conference call transcript.
All the raw material.
Yep. Okay, let's unpack this.
And our mission for you today is precisely that. To pull out the most important nuggets of knowledge, the key insights from all these different sources.
All right.
We want to help you quickly get a handle on the key takeaways, maybe some surprising facts from Ajanta Pharma's recent quarter. What's really fascinating, I think, is how these different bits of information, when you put them together, they paint a really complete, sort of nuanced picture of the company's health and its strategic direction.
So let's start with that big picture then.
Yeah.
The headline figures, the ones that immediately grab your attention.
Yeah.
Ajanta Pharma reported revenue from operations up a solid 14%, that's RSS, 2,303 crore, for Q1 FY26 compared to Q1 last year.
Good start.
EBITDA saw a 6% increase, reaching Rs 351 crore, and profit after tax, PT, that was up 4% to Rs 255 crore.
Okay.
So on the surface, decent growth numbers.
Mm-hmm.
But what do they really tell us about the company's, let's say, overall financial health?
Well, if you connect this to the bigger picture, these figures, yeah, they show growth, but I think more importantly, they showcase really efficient management and strong liquidity.
Okay, how so?
Well, digging a bit deeper, the company shows some really robust financial health indicators. You've got a healthy return on capital employed, ROCE, of 33%,
33, wow.
and return on net worth, RNW, of 26%. Think of those, ROCE and RNW, as ways to measure how effectively they're using capital, the money invested,
Right.
to actually generate profits.
Yeah, getting bang for their buck.
Exactly. And their cash conversion is, frankly, particularly strong. Cash flow from operations CFO was Rs 282 crore. Now, that's an excellent 80% EBITDA to CFO conversion.
That's high.
It is. And free cash flow, FCF, came in at Rs 209 crore, which is an 82% FCF to PANIC conversion.
So they're turning profits into actual cash very efficiently.
Precisely. They're not just making profits on paper. A big chunk is turning into real cash they can use, reinvest, whatever they need. These are like incredibly solid signs of financial discipline.
Okay, but you mentioned the PAT growth. 4% seemed a bit maybe lower compared to the 14% revenue growth.
Yeah.
There's a crucial detail here influencing that figure, isn't there? Something that changes the picture quite a bit.
Yes, exactly. Here's where it gets really
They
interesting.
take a hit, right? A 4x loss.
Yeah, a Rs 25 crore mark-to-market Forex loss in Q1 FY26.
And for our listeners, mark-to-market means it's more of a paper loss recorded due to currency swings, not actual cash out the door for operations.
That's right. In this case, it was apparently due to a sudden movement in the euro. Management specifically called it a one-time event.
Okay, so what happens if we mentally kind of pull that noise out? How do the numbers look then?
Well, this raises that important question, doesn't it? Why is it so crucial for you, the listener, to understand these underlying factors and not just stop at the headlines?
Because one-offs can distort the real picture.
Exactly. Because a one-time thing like this Forex loss can really skew the reported figures. If you look deeper and you exclude this impact, the operational picture changes quite dramatically.
Okay.
EBITDA growth, instead of 6%, jumps to a really robust 14%, with a strong 29% margin.
Wow, okay, big difference.
And PAT growth, instead of 4%, significantly improves to 12%, with a healthy 21% margin.
Right, so that reveals a much stronger core business performance than the initial numbers suggested.
Absolutely. It shows their core business is really firing on all cylinders. That's the kind of clean growth, that investors really want to see for sustainable performance long term.
That adjustment definitely puts the quarter in a different light. Okay, now let's dive deeper. Where is Ajanta Pharma seeing its biggest wins and maybe its challenges across its different markets? What's the story segment by segment?
Okay, let's break it down. The branded generics business is still the core, right? It represents a big chunk, 73% of their total revenue.
73%.
And within that, their India business, which is about a third of the total revenue, 32% that showed really impressive 16% growth, hit Rs 409 crore.
16% growth in India, that's very strong. How do they manage that, especially compared to the overall Indian market?
Well, they actually outpaced the Indian pharmaceutical market, the IPM, by quite a margin, 29% faster growth. They achieved 10.3% growth, while the IPM overall grew at 8.0%.
Okay, so what's behind that outperformance?
It seems pretty clear. Their volume growth was way ahead of the IPM by an impressive 73%.
73% more volume growth. Wow.
Yeah. And their new launches also outpaced the IPM by 46%. Ajanta Pharma strategy is heavily focused on chronic therapies. That now accounts for 65% of their sales.
Chronic, okay, so things like cardiology.
Exactly. Key areas like cardiology at 37%, ophthalmology 30%, dermatology 23%, and pain management 10%. And they keep launching new stuff. In Q1 alone, 8 new products launched.
8 in one quarter.
Including one that was first to market in India. Plus, they have this huge network, right? Over 3,500 medical reps covering more than 2.7 lakh doctors. It's really a story of targeted investment and strong execution.
So given all that strength in India, it was interesting to hear on the earnings call that cardiology specifically was maybe a little soft compared to the market in that area.
Yeah, that came up.
What's management's take on that? I mean, cardiology is a huge part for them. What are they doing about it?
Management was quite clear on the call. They said it's down to competitive intensity, not pricing issues.
Competition heating up.
Seems so. They explain they're actively working to correct it, and they expect improvement within maybe 2 to 3 quarters. Sounds like a temporary blip they're focused on fixing.
What?
And just to mention, their much smaller trade generic segment in India was basically flat, contributed about Rs 39 crore.
Got it. So moving beyond India, how are things looking in their Asia business? That grew 10%, hit Rs 304 crore, making up 23% of total revenue.
Yeah, Asia continues to be a solid performer. They kept up their launch momentum there too. 10 new products brought to market in Q1.
10 in Asia as well.
Mostly in those chronic therapies again. This just strengthens their portfolio across the 10 countries they operate in, Middle East, Southeast Asia, Central Asia.
And their outlook for Asia.
They've guided for mid-teens growth for the full year in Asia, so continued confidence there.
Okay, now here's an interesting one. While other areas grew, their Africa business, 18% of revenue, actually saw a slight 1% degrowth. Sales were Rs 228 crore. What happened there? That seems a bit unexpected.
It does seem counterintuitive at first glance. Management explained it by pointing to what they called a high base from the previous year.
High base, meaning last year was exceptionally good.
Exactly. They had really strong 28% growth in the prior year, which they said was basically double their normal growth rate.
Okay. So this quarter's slight dip is more like things returning to normal after a surge.
That's the explanation, yes. More a normalization than an underlying issue. And despite that short-term headwind, they still launched 2 new products in Africa. They say they remain confident in the long-term potential there.
And the outlook for the full year in Africa.
They expect mid to high single-digit growth for the full year and then bouncing back to double-digit growth next year. So clearly playing the long game in Africa.
Right. Okay, shifting gears now to the U.S. generics business. That's a substantial piece, 24% of total revenue, and it delivered, well, the word used was excellent. 36% growth, sales hit Rs 310 crore. That's a real standout.
It absolutely is a very strong performance, and this impressive growth, it seems, is largely down to new product launches.
The pipeline kicking in.
Yep. 5 new products launched in the second half of last fiscal year, plus 1 new launch in this Q1, and they're expecting another 2 to 3 launches this year. Shows a strong pipeline execution.
How many products do they have in the U.S. now?
Currently, they have 47 products on the shelf, and importantly, they have 21 abbreviated new drug applications, ANDAs, waiting for approval from the FDA, so more potential to come.
And it wasn't just new launches driving growth.
No, they also mentioned market share gains in existing products contributed. Sometimes that happens because competitors actually exit the market. It's a common dynamic, kind of opportunistic in the generic space.
Right, picking up share where others leave.
Okay.
And finally, there's the Africa institution segment. Much smaller, 3% of total revenue. It saw an 8% degrowth, revenue at Rs 38 crore. What's the story with this sort of niche part of their business?
Yeah, that segment is mostly an anti-malarial business. Its performance is highly dependent on procurement agencies, tender cycles, that sort of thing.
So inherently lumpy and unpredictable.
Exactly. Which leads management to maintain a pretty cautious outlook on it. It's a specialized revenue stream, contributes to their diversification, but it's not really a core predictable growth engine like the branded generics.
Got it. So we've seen the numbers, the market performance, But what's the sort of engine room supporting all this growth? Let's talk about their R&D, their manufacturing muscle, and how they're managing costs.
Good question. Let's look under the hood. The R&D expense for Q1 FY26 was Rs 56 crore. Now that translates to about 4% of total revenue.
4%. Is that high, low, average for the industry?
It's reasonably typical for a generics-focused company with branded ambitions, but the key point isn't just the percentage, it's what it represents. That's the work of their 850-plus scientists.
Right, the innovation engine.
Precisely. Those continuous new product launches we talked about across India, emerging markets, the U.S., they're a direct result of this R&D investment. So the growth you see on the top line, it really stems from these foundational investments in innovation.
And you mentioned they're entering new therapeutic areas in India, like gynecology and nephrology. How are those shaping up? Still early days.
Very much so. They saw them as sort of natural extensions, strategically chosen because they see growth potential in the Indian market there.
Makes sense.
But they were launched less than a year ago. So management basically said a proper performance review for these newer segments will probably make more sense towards the year end once they've had more time to actually ramp up.
Okay. And what about manufacturing? Where do they make all these products?
They have 7, what they describe as world-class manufacturing facilities, all in India, catering to global demands.
And are they investing in expanding capacity? What's the CapEx situation?
Yep, they are. Their capital expenditure, CapEx, was Rs 72 crore just in Q1, and their full-year guidance is around Rs 300 crore.
300 crore for the year. Where's that going?
A significant chunk is earmarked for capacity expansion. For example, they mentioned a new liquid plant in Pithampur that's specifically designed to cater to emerging markets, so clearly signaling ongoing investment in future growth and scale.
Okay, let's talk cost management now. What about their gross margins? They seem quite high. And why did other expenses jump up so much this quarter?
Right. The consolidated gross margin stood at a pretty robust 79%.
79%. That's very healthy.
It is, and it's an improvement of 200 basis points, or 2% compared to before. This was mainly driven by a better product mix, selling more higher margin stuff, and also favorable prices for APIs.
APIs, the active pharmaceutical ingredients, the core drug components.
Exactly. Cheaper raw materials helped. But there's a slight caveat. About 1% of that improvement in Q1 was actually due to a one-off accounting thing, a provisioning for returns and expiries. So that specific bit probably won't repeat.
Okay, noted. And the jump in other expenses, up 42%.
Right, that big increase. It's down to a couple of main things. One is those strategic investments in their branded generic business. That means spending on promoting new products, hiring more people.
Right, investing for growth costs money.
It does. And the other big factor was that Rs 25 crore mark-to-market Forex loss we already discussed. That sits in other expenses.
Okay. That explains a large part of it.
Yeah. And personnel costs were also up by about 7%, mainly due to adding more medical reps. Again, investing in that field force.
Makes sense. And one more efficiency point, working capital. Management apparently said they've hit peak efficiency there. What does that imply? Have they kind of squeezed all the juice they can from managing inventory and receivables?
It pretty much implies that, yes, management stated quite clearly they believe they've reached peak efficiency in their working capital cycle.
So no more major gains expected from just managing cash flow better?
Seems not. It indicates that while they're managing it very, very well, you shouldn't expect further big improvements from that particular area in the near term. They've optimized those processes about as much as they can, it sounds like.
Okay. So bringing this all together then, we've looked at the numbers, the markets, the engine room. What does this deep dive tell us about Ajanta Pharma's overall strategy, their roadmap and vision for the future?
I think their strategic priorities come through pretty clearly and consistently from all the sources. It's about, 1, continuous new product launches across all their markets. That's key.
Keep the pipeline flowing.
Absolutely. 2, gaining market share with their existing products, mainly by making their field force more productive. 3, a push into new countries and new therapeutic areas.
Like expanding reach.
Yep. 4, optimizing expenses where they can without hurting growth. And 5, a big focus on digitalization across, well, pretty much all functions. It's a fairly comprehensive approach, hitting growth from multiple angles.
And looking ahead, what are they guiding for in terms of profitability, those margins?
For the full fiscal year, they've guided for an EBITDA margin of 27%, plus or minus 1%.
27%. So similar to last year, despite the gross margin improvement.
Right. That's because of those elevated investments in growth. We talked about all the new launches, the people, the market entries. That costs money up front.
but they expect that to pay off later.
That's the plan. They do have expectations for margin expansion starting in fiscal year 2027. That's when these current investments should really start to yield results and they get more benefits from scale.
Okay. And one last thing. Any plans for inorganic growth? Are they looking at buying other companies, making acquisitions?
Yes, they confirmed they are actively pursuing inorganic growth.
Where are they looking?
Their number one focus for acquisitions is India, followed by opportunities in Asia and Africa.
And what kind of businesses are they after?
Specifically targeting branded generics businesses that offer, clear synergy with what they already do, their existing operations and portfolio.
Make sense? Stick to what you know.
But they did emphasize that while they're actively looking, these opportunities can't be forced. They're waiting for the right strategic fit, the right deal, not just buying growth for the sake of it.
Right. So wrapping this up, this deep dive into Ajanta Pharma's Q1 FY26 results, it really paints a picture of a strong quarter, doesn't it? Shows that underlying resilience despite that one-off Forex impact. It seems pretty evident their strategic investments, especially in branded generics in India and the US, are really fueling the performance. And they definitely seem to have a clear long-term vision.
Yeah, I think that's fair. And maybe this raises a final interesting question for you, the listener, to think about.
Go on.
Considering Ajanta Pharma's clear strategy of reinvesting quite heavily right now in its core branded generics business, aiming for that long-term growth and margin expansion, maybe a year or two down the line, how do you personally balance that? How might you weigh the immediate financial performance we see today against the anticipation of future returns from these strategic and currently quite costly investments?
That's a great point. It's that classic dynamic, isn't it? Balancing today's results with tomorrow's potential, especially in a super competitive industry like pharmaceuticals. Definitely something to mull over.